Uh, Welcome along everybody to the Butcher and Barlow and DTE webinar, How to Weather the COVID Storm and Thrive. My name is Amy Norman, I'm one of the partners here at Butcher and Barlow, and I'm going to be the moderator for this webinar. Over the next hour, my colleagues and the specialists from DTE Business Advisors will be giving you some practical advice on how to sort of come through these unprecedented times with not only a business intact at the end of it, but hopefully a thriving business. There is a Q&A feature on the Zoom webinar. If you have any questions on any of the sessions as we go through, by all means add your question to that Q&A box. We'll try and answer them within this actual topic area. If we don't get to them in that time, we'll try and cover them off at the end of the webinar. And as a fallback, those questions are recorded so we can get back to you personally on anything at any time. We're also going to be recording the session, and we'll let you know where that is stored so you can play back any bits that you want further advice on in due course. So we'll move on to our first speaker for the afternoon. This is probably one of the biggest concerns for most businesses during this time: how to manage cash flow effectively in the current environment. And Richard Bell, who's an accounts and audit manager at DTE, is going to be talking about that. So introduce Richard.
Hi, thanks for that, Amy. So as Amy mentioned, I'm from DTE. I'm an audit partner there and deal with a number of size businesses. I think one of the big challenges that's come out of COVID-19 is that it's actually made businesses realise that they have to understand and manage risk in their business. Now, one of the biggest risks for any business is that of cash flow. And I can't say too much that cash is king, the old adage that I'm sure most of you have heard. Ultimately, there's a number of things that you have to do to try and make sure that you come through COVID. And I'm going to talk about three separate areas. One, there's managing cash into your business, whether that be income or income from loans, etc. Two, reviewing costs. And then three, just some other things that you need to maybe bear in mind, because ultimately there are still other issues which might not actually be directly relating to that, but probably will do. So I suppose if we sort of look from the perspective of income initially, the key is to try and get money into the business. So, you know, as your businesses are starting, a lot of businesses have stopped or not been working. Some lucky businesses are thriving in the current environment, but for the majority, pressure's been put on the business. So we're now getting to the point where we're starting to manufacture again, get goods out. So really, I think it's really key and important that you make sure that you're managing your debtors and getting monies in. So ultimately, at a very basic level, that means getting your invoices out on time. Probably after that, contacting your customers to make sure that there's no issue with the invoices, and just, you know, making people remember that you're there and you need to be paid. Ultimately, if you're going to take new customers on, you need to make sure that they're credit worthy. So why is that different to what we've always done? Well, it isn't really. You know, ultimately, there's just more risk now, so you have to be slightly more careful. You sometimes have to review things in a different way. So you might want to consider giving people discounts for upfront payment, so that minimises your risk. You also have to make sure that you have the resources to carry through so that ultimately you can finish the job and get paid. The other way to get some cash into the business is there's a lot of government grants and loans about. The loans I'm not going to talk about. Andy, who follows me in this presentation, will talk about them in more depth. That's more of his area. So the second part that I'll briefly talk about is sort of costs. Now, ultimately, getting your debtors to pay you is a difficult thing, because ultimately you're reliant on them. You have more control when it comes to your costs. So ultimately, you know, you need to try and either not pay people or pay people on an extended basis. Now, you have to do this intelligently. Speak to suppliers. Now, I know that ultimately it's a very strange situation, but it's all about sharing the pain. You know, your suppliers may be cash rich, can afford deferment of terms, can afford things, but ultimately speak to them and make sure that you can get something that works for yourselves. The other thing that businesses should be, and I would hope are doing, is deferring some of their HMRC liabilities. Some of those are automatic. Some of those need to be applied for. I believe Gareth might talk a little bit about that later on. Other things that you can be doing and should be thinking about doing is obtaining payment holidays on your loans or mortgages. I think it's quite important to be in touch with your bank and make sure that your relationship's good with the bank, because ultimately we're still in strange times. Banks don't like surprises. So as long as you're in contact with them, you can usually manage to do things, and things have been set up to make sure that they're there to help. Ultimately, a lot of businesses, what they should be doing is reviewing costs, making sure that you're cancelling sort of expenditure that's not required. So that would be sort of discretionary costs. You know, a lot of businesses will pay things on direct debits and they might have forgotten about some of them. So you should be reviewing your bank statement, making sure that you're not paying for things you don't need. You also need to make sure you're paying the right level of tax and claiming relief from the HMRC that you can. One of the better or generous reliefs at the moment is R&D tax credits. Gareth will talk about that later in the presentation. And then I suppose lastly, on a cost basis, you know, if for a business, if it's coming through the other side and things are going well, then it'll be back to business as normal. Some businesses might be struggling, so you know, a lot of businesses' biggest cost will be payroll, and therefore you may have to look at adjusting that, whether that be through reduced working weeks, whether it be salary cuts or freezes, or whether it be through cutting staff numbers. That will depend on the business, and Justin will talk a little bit about that later on today as well. Other things that you do need to be aware of, whilst there will probably be financial in certain ways, you know, you have to watch out for frauds. People are still very quick at trying to separate you from your money. There are old frauds, there are new COVID frauds. You just have to be aware of them, so that, you know, people are busy, there's a lot happening, and you just need to make sure you don't get caught out. Other things to check is if you do have business interruption insurance, make sure that you're covered and there's no exceptions. For other insurance policies, you might want to make sure that if you've got a building, there's no clauses about the building being unoccupied for a certain time. You just want to make sure you're covering these things off. Ultimately, in the longer term, you will need to forecast to make sure that you can repay some of these loans that you might be taking out, some of the costs that have been deferred, and ultimately check how they think the business is going to move. And you know, ultimately these things are all quite general, but they're all very important. So that I will still be here at the end, but I will hand back now to Amy to move on.
Thank you very much, Richard. So we're moving on now to Andy. As we've just heard, cash flow is the lifeblood of any business, and you may have a need for some extra funding from outside, and Andy's going to discuss the options available there. He's the Corporate and Finance Director at DTE.
Hello, Andy Humphrey from DTE. I work in the corporate finance team. Needless to say, normally our activity is buying and selling M&A with a lot of fundraising. Life has changed, and we've spent the last 3 months primarily helping SMEs with their bank funding in relation to COVID-19. So I'd like to talk about two of which are pretty similar, but different, and a third particular fund available from the government. They are, in the order I'll talk about them, CBILS, so the Corona Loan Business Interruption Loan Scheme, the Bounce Back Loan, and the Futures Loan. So if I start with what we call CBILS, so the Interruption Loan Scheme, this is actually split into two, is a larger and a small one, but primarily the characteristics of it are similar. So I'll run through and just point out any differences. So loans are available up to £5 million, and the repayment terms are typically up to 6 years. It can be less, it's on a bank by bank basis. The government will cover the first 12 months of interest payments. It's effectively interest-free. Interest is charged, but then there is a payment made by the government. It's called a business interruption payment. On the facilities, which is on the smaller loan, up to £250,000, there's no requirement for personal guarantees, which was a topical subject early on, but there are no requirements. Personal guarantees may be required at the lender's discretion for facilities above 250, but they do exclude the principal private residence, i.e. the house. So the way in which that works, first and foremost, it's discretionary, so the bank don't need to take it, and our experience is that they haven't generally, but where they do, they would look to recover whatever monies they could from the company and the company's assets. And once they've got that, they'll take a maximum of 20% of the outstanding from the individual. So yes, it's a guarantee, but they do go to other places first. Overall, there are over 80 accredited lenders at the moment. We've got access to them all. They're fairly well advertised as well, and you can find it on the government's website who they are. The facility started in March and will be running for 6 months to September at the moment. It may increase depending on activity. General eligibility is SMEs. That includes limited companies, sole traders, partnerships. It's got to be UK-based trading activities. The restriction in turnover or revenue is £45 million, even if that's across a group. So got to look at the whole group. If it's above £45 million, it's not eligible. The way in which we tend to put this, try to describe, will the banks do it or won't they, is say, if life was very difficult before and this is just a reason to borrow some more money to extend the life of the business, no, they probably won't. If it was a business that before COVID would have serviced this level of borrowing, and hopefully after COVID will do the same, and right now in the middle of all of this, it can't. Generally, the way in which the banks have looked at it has been supportive, and they are looking to lend. There is a clause within the criteria is that if a business is in difficulty as at December 2019, then they can't apply. That's quite a complex little bit, but I would suggest it's probably summarized in my previous statement to say, would the bank have lent in normal circumstances? Businesses from any sector can apply. The ones that are excluded are banks, insurers, and public sectors, charity and state funded primary and secondary schools. So most businesses out there can do. Term loans and asset finance facilities are up to 6 years, and overdrafts and invoice finance facilities are up to 3 years. The main way in which we work with clients to try and help them get the money, and we put together a very small business plan. We take into account all of the different aspects that the banks are looking for. It's something we can put together quite quickly, and we've probably put together about a dozen, and they've all been successful so far. So just to give a flavour, in my view and in my experience, the banks have been pretty supportive. That business plan is just a bit of history where they don't know about it. what COVID's done to the business, what the cash flow might look like for the next 6 to 12 months based on, again, what we know, and what factors the business has already taken to ameliorate any of the difficulties that it might have had, and might be furloughing, it might be grants, it might be VAT deferments, etc. So what actions has it taken? So that's the main loan. The second one is called the bounce back loan, which is a simplified and smaller version of what I've just described. It is pretty much, it's an online application. We've assisted a couple of clients and actually done it for them, with them online, but it's pretty straightforward. The lending is £2,000 up to £50,000, subject to a maximum of 25% of the business's turnover. The government, again, will cover the interest payments, and there's no capital loan repayments for the first 12 months for both of those. The interest rate is set at 2.5% over base rate. What I didn't mention in the previous loan, apologies for that, is the interest rate is up to the bank. We're tending to find it's between about 2 and 4%. But on the bounce back, it's fixed at 2.5%. Lenders do not and cannot take personal guarantees on the bounce back loan. There's now 20 or 30 plus accredited lenders. Again, it's advertised on the government website. More and more are becoming part of it. The scheme's initially open until November 2020, so another 5 months. Overall, it's a very, as I say, a simplified version of CBILS, and to date, we found that everyone that we know that has applied for it has got it. The eligibility is the same about liquidity and bankruptcy and things like that, but apart from that, it's straightforward. The last one I'd like to talk about is the Futures Fund, which is a bit more specific, but I will briefly mention it. It's loans, again. It's between 125,000 and £5 million. It's subject to a third-party investor having already put that amount of money in or be putting that amount in. So it's more where a fund is pre-revenue, pre-profit. Typically, they would be able to find some funds from somewhere, from a business angel, from private investments, from venture capital, and they're unable to get it at the moment. So the bank is matching the funding put in by private individuals, not the owners of the business. It's third-party investment. Again, the way in which that is done is through a business plan. It's looking to put money in on a loan basis and then possibly convert it at some point in the future. But it's a means to an end for possibly a tech type business, but certainly a new business where they're looking for investment, but they can't get it at the moment. So they're the three I've sort of highlighted. I did have one question from one of the panelists beforehand, and that was about rental income. And the question was, if it is paid into a personal account rather than the business account, is that eligible? I would say the answer is yes, in general terms. We would have to just put together the case and demonstrate it in the business plan of all of the income and all of the assets and all of the costs and all the liabilities, so that the bank fully understood that. So in general terms, we think we could generally work around that. To finish, I would say that it's been a highly successful. To start with, it was very difficult to get through to the banks. They were so busy. Our recommendation is normally to go to your incumbent bank. It is far easier. However, there are banks out there and funders out there that are now looking for business and are using this as a means to do that. So we will cast the net wide where we need to do. So that's me done. Amy, hopefully that's just about on time and gives people sufficient information for the moment.
Thanks, Andy. That's great. So moving on now to the next presentation, we're moving to Justin Kelly, who's our Head of Corporate and Commercial and our Employment Law Specialist at Butcher & Barlow. He's going to be looking or giving you an update on the furlough scheme and just having a quick look at redundancy during furlough. Okay, thank you.
Yeah, hi everybody. So I'm Justin Kelly, partner in employment and commercial team at Butcher and Barlow. So following on from Andy's content on grants, talking first about the furlough scheme. Everybody's familiar with that by now, of course. It is a grant of sorts. The scheme known as Coronavirus Job Retention Scheme, again, everyone familiar with that, but just a recap of where we are at the moment. 80% of pay can be reclaimed plus NI contributions and pension contributions up to 2.5k. You can't now furlough anybody who hasn't been furloughed before the 10th of June, but for those who have been furloughed before the 10th of June, you can still rotate them and switch them and bring people back and send them back on furlough. So far, although some hiccups at the start with government guidance, it's pretty straightforward. That is about to change. We've now got something called the Flexible Furlough Scheme, or FFS for short. I've tried to read it. Those of you who read it will see why FFS is a perfect acronym for this scheme. Incredibly convoluted, very difficult to read. It's going to be very difficult to administer. I don't have time to trawl through all the points, but some headline points from the FFS scheme. Comes in 1st of July. Principle fairly simple. From 1st of July, employees no longer need to avoid working for the employer and can work some of the week for you and be furloughed for part of that week. There's no longer a requirement that they are furloughed for 3 weeks at a time, which gives a bit more flexibility. The only stipulation is that you can only claim once a week for a particular employee through the CGIARS portal. There are lots of government articles on this on gov.uk websites. Quite hard to find. If anyone wants to email me, I can send you all the links to the various articles and various examples on this. But headline points. Employers can claim 80% of salary for the hours that the employees don't work from their normal working hours. So a very simple example, if you've got a 40-hour week worker, they can come in and work for 20 hours and you pay them whatever the contract says or whatever you agree to pay them with their agreement. For the remaining 20 hours, you can reclaim at the moment 80% of those hours that they are furloughed in that week. As I say, there are many examples of different scenarios where people don't have regular hours, difficult to read, not reader friendly, but always happy to answer any questions anybody has on them. Slight note of caution on the new FFS scheme, insofar as previously under the CGIARS scheme, you had to have some kind of record in writing is all that was required. The new FFS scheme seems to suggest there must be a written agreement with the employees. Now, that puts a higher burden, which means probably a variation to the employment contract. The Employment Lawyers Association, of which I'm a member, are looking into this. They're making representations to the government. Hopefully they'll change it and make it more simple. Other changes in the CGIARS scheme, from August, you can still reclaim 80% of pay for furloughed staff, but employers must make the employer NI contributions, which they don't at the moment. From September, it goes down to 70% with a cap of 218,750 per week. From October, reduces to 60% with a cap of 1875 per week. After October, that's it, all finished. Highly unlikely the government will extend that because of the significant cost to it. So where this leaves us is the CGRS scheme is, while it's been extremely useful to employers, is becoming more complicated, difficult to administer, and certainly less generous, which I know from experience from my clients is now leading to employers thinking the next step is redundancy. One of the questions we've been taking a lot of calls on is, can we make employees redundant whilst they're on furlough or while the CJRS scheme is in place? The advantage to employers, of course, is simple. If you give an employee notice whilst they're on furlough leave, you can pay them the notice pay whilst on furlough and reclaim that notice pay. The obvious advantage being that at the end, when the notice expires, yes, you have to fund statutory redundancy pay, but will have a significant reclaim on the notice pay, which will make it much more palatable for employers, much less expensive in the redundancy process. There is a line of argument with some employment lawyers at the moment that giving notice or terminating employment contracts whilst the CGRS scheme is in place could be unfair, or employees could allege it was unfair. The reason for this seems to be that the general law requires that employers consider all possible alternatives to dismissal. One alternative, of course, might be, well, keep them on, but keep them furloughed. An employer must act reasonably in all the circumstances. My personal view on that is that such claims are unlikely to succeed. And I say this because CGRS is, of course, first and foremost, a job retention scheme designed to avoid redundancies. And if as an employer you've decided that come what may, in August, September or October, whatever it may be, that the redundancy is inevitable, then it would be an odd decision, I think, for an employment tribunal to say that you should have kept them on until the end of that scheme and claimed government money, knowing that at the end of it, there was no job anyway. That will come out in the wash. There'll be lots of tribunal litigation at the end of all this, where all these arguments are raised. The perhaps more compelling argument that employees may have is that when looking at whether it's reasonable in all the circumstances, they may argue, well, why didn't the employer wait and see if things were actually as bad as they thought they may be? So if you dismiss somebody in July, when the scheme or the CGRS scheme runs till October, perhaps things might not have been as bad as the projections suggest. Again, I would suggest that those arguments are likely to fail because the decision must be judged at the time the decision was made. At that time, was there a reduced requirement for employees of a particular kind, which is the definition of redundancy? And if the answer is yes, well, if things change after the date of that decision, unless it was wholly foreseeable, again, I think that argument should fail. Before closing, I received a question from one attendee prior to this, and the question was, if we have to make redundancies, will the government assist with redundancy pay? Never been addressed by the government, but the obvious answer surely has to be no, they won't. The whole focus of the government to date has been on job retention, and it would seem nonsensical for the government to offer to assist employers to make employees redundant. They would have a double hit in the sense they'd be paying for them to be made redundant and then potentially paying their benefits, universal credits, whatever it may be. So that's all from me. If anyone has any questions, there is the Q&A button, or by all means email. Thank you.
Thank you, Justin. Our next topic then in the agenda is includes a couple of points you can consider to better manage your financial situation, asset protection and R&D tax relief, and that's going to be discussed by Gareth Costello, who's a Senior Tax Manager at DTE. Thanks, Gareth.
Thanks, Amy. Good afternoon, everybody. My name's Gareth Costello from the tax team at DTE. What I want to cover off in this session is kind of take a tax perspective on a couple of subjects. One of them being cash flows, which Richard covered earlier at the start, looking at tax deferrals, time to pay, research and development, R&D, which has been a very useful boost for cash flows for a lot of clients. And then secondly, to look at sort of asset protection, something that I've worked with James at Butcher and Barlow for a number of clients, both before and after sort of lockdown. Without further ado, apologies if I have to rattle through this, given the short time frames we've got. Obviously, cash flows, a big part of cash flows for businesses support-wise has been the various grants, reliefs and schemes that we've had, and we could pick any of those subjects in isolation and probably cover the full hour. Justin's just done an excellent update on the job retention scheme, or the furlough scheme, as we know it as now. As a brief aside, the word furlough, it wasn't in many people's vocabulary prior to lockdown in March, and here's a little bit of unknown trivia perhaps, because I'm reliably informed that if you watch the original Jungle Book movie, the elephants, when the elephants are doing the elephant song, as elephants do, they mention the word furlough, which I think is pretty bizarre. Maybe your kids or grandkids can check that afterwards. If they don't mention the word furlough, then I've clearly been set up. Anyway, trivia aside, cash flows. In addition to the furlough scheme, we have for the self-employed income support scheme. Again, without getting into too much detail, the similarities with the furlough scheme are that it's been extended, and like the furlough scheme, it's been sort of tapered down in terms of the amount of relief given. My main sort of point I wanted to make today really was just to remind recipients of it that it's taxable. There's been quite a bit of coverage that some clients, maybe because it's described as a grant, I don't know, that weren't aware it was taxable. It's liable to tax, it's liable to class 4 national insurance, it's taxable in the year receipt, so it will go on your tax return if you've received it for 2021. We did get a question from the attendees on the SEIS scheme, the self-employed scheme. The question was whether or not it's possible to cover property income. Unfortunately, the answer is no, and the reason for that is the criteria or the manner by which individuals are eligible or not is whether they've got income that they report on the trading pages of their tax return. So, property income ordinarily, as the name would suggest, will be on the property pages. I mean, you might get an exception for something like a bed and breakfast in, when you're doing that type of service on top of the property. But generally speaking, property income, and also including furnished holiday lettings, will not be declared on your trading pages on your tax return. And as that's the main criteria for eligibility, it does mean that in most cases, property won't, you can't cover it. It's just trading. I mean, it extends to sole traders and partners. Unfortunately, property income is not covered. Another big area that HMRC sought to help businesses was various tax deferrals. The most obvious one that came out was an automatic VAT deferral, and it was any VAT that fell between the 20th of March through to the 30th of June. So we're nearly coming to the end of that period. and that would pick up any monthly payment, any quarterly payment arising in that period. Basically, the automatic deferral being it doesn't need to be paid until 31st of March 2021. One thing to note as a sort of housekeeping, businesses had to sort of turn off the direct debits that otherwise would have automatically taken the payments. As we're nearing the end of this sort of deferral period, businesses just need to remember to turn back on the direct debits. We also had a specific income tax deferral. Payments otherwise due on the 31st of July, deferred until the 31st Jan 2021. Main point on this particular deferral is it's not just the self-employed, it is any self-assessed income tax payment that otherwise is due for payment on the 31st of July. So quite a helpful boost for anybody who would otherwise been writing a check out at the end of July. They're the two automatic sort of time to pay and deferrals that we've got, and the emphasis there is in automatic, because when you look at other taxes, corporation tax or pay as you earn, or maybe VAT from a period outside of this deferral period, HMRC have definitely been more accommodating for requests for time to pay. What you have to do though is contact HMRC to get that agreement in place that you are going to defer a liability. We're already starting to see cases where clients who might have been due a refund, it could have been a refund from R&D, or it could have been a furlough scheme repayment, and HMRC have gone and automatically offset an amount owing. You know, and the reason being is the client thought they'd automatically got a deferral of perhaps pay as you earn a corporation tax, but you know, HMRC, they haven't got a crystal ball. The key message is to pick the phone up and start the dialogue to get agreement. They're definitely more accommodating. I know it can be quite daunting having those conversations with HMRC. We can gladly help here at DTE with that. One of my colleagues, Alan, it's the sort of thing that he's turned into an art form. But you know, there are opportunities to defer most taxes, but it's not automatic. It's only those VAT payments and the 31st July income tax. Everything else, you've got to get something in place, formalised with HMRC. Moving on to R&D, Richard mentioned this at the outset. Rich and I have worked on quite a few cases recently where the cash flow boost from a research and development R&D claim has been valuable for businesses. And to be fair to HMRC, they have been very good in terms of the speed that they turned around claims. And just as a bit of background to R&D, I mean, our main message that we find ourselves repeating to prospective clients is it's not about sort of men in white coats. I don't think there's a single business sort of sector or sector of business that we haven't seen and been able to do an R&D claim for. And one of the reasons for that is it's not just sort of end product type development. It can also be internal systems and process improvements in businesses. So you can see how that can be adapted and you know, and used by pretty much any type of business. And it's very valuable. I mean, just to put some numbers together, the scheme works by either giving you a sort of enhanced deduction, so you're going to reduce your corporation tax bill, or if you're loss making, it's going to give you a sort of tax credit that you can reclaim. I mean, even just a sort of relatively simple case where you identify 50,000 worth of R&D expenditure in a period, you can claim for 2 periods, double that up, take the enhanced deduction, you're talking £25,000 worth of refunded corporation tax. As I say, hence the valuable lifeline that's been for businesses. And we'd always encourage clients to pick the phone up and discuss it with us, as I say, because quite often clients are surprised once they have the conversation to actually see and learn and realise that they're doing R&D. Moving on to the question of asset protection, as I say, James Hodgson at Hudson Barlow and myself have worked on quite a few clients, both before, pre-lockdown and post-lockdown. And the principle is that you've got a trading company that's perhaps built up surplus cash, or it's got investments. It might be the trading premises, or there could be other investment properties. And the worry is about the potential impact and risk that the cash and assets are placed at by being alongside the trade. So the principle is to try and manage that risk. The simplest way to manage the risk is by the use of a holding company. A very simple principle. What you're basically doing is you're taking the trading subsidiary and putting a holding company on top of it. You do a share exchange process that prevents there being a capital gains disposal for the shareholders. Once you've got that structure in place, you basically take the assets and move them up to the holding company. And once they're in the holding company, they're then protected from the trading company below, which is obviously the key objective. Beyond that, I mean, you can then get into much more detailed restructuring. I know Jonathan's going to cover that in his session that's coming up. There's 4 or 5 different ways you could demerge your business, which is a step further in terms of complexity. That might be separating different trades. It might be separating a trade from an investment. Again, it might be protecting cash and investment properties. But the key principle is the same in terms of the objective being to protect those assets and that cash from the risks of being alongside the trade. And the main message is, I think, is pick the phone up and speak to us, and you know, James at Butcher and Barlow as well, because it's important to get the right type of structure. There's various clearances with HMRC to cover off as well. We don't want to give clients an unexpected tax bill, clearly, but obviously it can be very valuable, you know, particularly in the current climate. As I say, it's something that's been done before and after lockdown, but lockdown has kind of brought it into sharper focus. I hope that's been helpful. I'll hand back to Amy now. As I said, please get in touch if you have any questions, and I'll pick up any questions at the end as well.
Thanks, Gareth. I think, as you've already clearly introduced Jonathan, coming forward with business restructuring and talking about shareholders agreements. Jonathan's partner and corporate and commercial lawyer at Butcher and Barlow. So I'll hand you over to him. Thank you.
Thank you very much. As Amy said, I'm one of the corporate partners at Butcher and Barlow. Just want to run through in the next few minutes, just looking at restructuring and things that we can do in relation to your business. Primarily, this is focusing on limited companies, but we are available to discuss LLPs, partnerships, and the like. I think one of the biggest things that's come through in the last 2 or 3 months is something of change. Whoever you speak to, the plans that people have put in place maybe have been there for years. All of a sudden, within the space of a few short weeks, they've changed. Now, that might be people's retirement plans, it might be plans for investment, plans for future development, but all of a sudden these plans that are in place have had to be ripped up. So we are now looking at a new landscape, and it may well be that people who have joined the seminar today, you had plans for retirement, you may have an exit strategy that has been lined up, and all of a sudden that's changed. It may well be that you're having to push those exit strategies back, or it may well be that you're bringing them forward, and we can look at potential ways in which you can look to do that. I think what we've found, certainly as a business ourselves, is that people have reacted in different ways to the crisis. Some have come through it very strongly, some have risen to the challenge, and then perhaps other people within your business, within your organisation, who you had great plans for, perhaps haven't reacted or adapted in the way that you hoped. And again, something that I want to touch on in a moment is just how you can look to incentivise people within your organisation that you've identified are the managers, the directors of the future. So we've focused quite a bit already on taking on debt, but we also need to consider not only taking on borrowings, grants, things like that, but also an equity investment. So maybe if we just focus just for a few minutes on how you can unlock money that you already have in the company. It may well be that some of you have decided that you want to retire, that you've had enough in terms of the changes that are facing the company, maybe new technology, retraining people, looking at diversity of the business that you're undertaking. you may feel that you haven't got the appetite to do that. One way that both ourselves and your accountant can help is looking maybe at the possibility of extracting undistributed profit, undistributed reserves within your business by way of a buyback of shares. So the way that this would operate is that instead of your business partner, if we work on a model of a 50-50 business that's owned by two people, instead of it being the case that your business partner buys you out, what we can actually do, if there's money within the company that hasn't been taken out, the company can actually buy back its own shares. It's quite a straightforward procedure. It's governed by the Companies Act, but what that enables you to do is to enter into a written agreement with the company, whereby if, for example, you have 100 shares and you own 50 and your business partner owns 50, the company would buy your 50, your business partner then owns 50 shares in a 50-share company, so he owns 100% of the company, and the company has paid out from its reserves the purchase price of the shares. Now, there are things that we need to deal with in that way in terms of written agreements, certain resolutions, agreeing a valuation, all of which we're able to undertake. But oftentimes people think, I'm not going to be able to sell these shares in the current climate. Well, sometimes it's worth just looking in, seeing whether you have cash reserves, which a lot of companies did have going into the crisis. And again, that's just something to bear in mind. The other thing to look at in terms of restructuring is an equity investment. Now, that might be looking for a third party to come in and invest in the company. It might well be encouraging part of either the existing management team or maybe a new wave of employees that you want to promote to come in, take a stake within the business and invest in that way. What we would say is there are two or one particular model that you could use if it's employees that you want to either bring into the business or encourage and retain in the business. HMRC operate an approved scheme called an Enterprise Management Incentive Scheme. And this operates on a 10-year period or maximum of 10 years, whereby what you can do is sit down with an employee and say, right, we want you to be part of the business going forward. The value of the shares of the company today are worth £1. If the company hits all of its targets over the next 5 or 10 years, whatever conditions you want to put on, and you can put whatever you want on, or if you as an individual hit all of your targets, you have got an option to buy shares in the company. Now, the incentive for the employee is that the exercise price, the trigger price for buying those shares is today's valuation, so £1 a share. Now, in 10 years' time, hopefully the value of the company is increased, whereby the shares are worth, say, £10 per share. So the employee, by staying with you, by working hard, by developing the business, they benefit from having the ability to buy at £1 a share that is already worth £10. Now, again, that's something that requires a valuation. It requires us as solicitors to draw up all the necessary documentation. But it's certainly very popular when you have a key employee that you want to retain who will then put an equity stake into the business at some point in the future. If you're looking at an external equity investment whereby there is a third party who wishes to take a share in your company, however big that percentage may be, the one thing that we would always recommend, and it's absolutely crucial that you do this, is to get a shareholders agreement put together. I always describe them as being an umbrella. You only ever get them out when they're raining. Now, what that means really is you can work with somebody, have a business partnership, operate a company for a number of years, and you get on fine. It's only really when you fall out or there's a difference of opinion or somebody wants to leave that you would get out your shareholders agreement and say, well, what did we actually agree when we were all friends, when we set up the business initially? And a simple shareholders agreement should cover what happens if someone leaves or wants to leave, and a mechanism for the other person to buy them out. What you don't want is somebody turning up on a Monday morning saying, I met your business partner in the pub on Friday and I've bought the shares from him and I'm now your 50% shareholder. So you build in what are called preemption rights that would enable somebody to offer you, the outgoing partner's shares, to the remaining shareholders. The other thing to cover is what happens in the event of death, or what happens in the event of long-term sickness. You might also want to cover things such as roles and responsibilities, putting in measures that prevent one shareholder incurring expenditure or debt on behalf of the company, or hiring and firing people without other people's consent, other shareholders' consent. Looking at things like restrictive covenants. What you don't want to do is pay someone out for the shares and then they go and set up against the business next door in 6 months' time. You'd want to be able to ensure that you have a protection for your asset value that you've just purchased. So, as I say, it's not all about taking on debt at the current time. There are certainly people out there who have got cash to invest. They've got a desire to invest in private limited companies, in LLPs and in partnerships. So whatever advice you need, whether it's in relation to an enterprise management incentive scheme by retaining employees, or looking at external investment, or even just putting in place something that you have on the shelf for 5-10 years down the line, come and speak to us about shareholders agreement. You've got all of our details. Members of the team would be happy to discuss it with you, and we can set things up from there. Thank you.
Thank you very much, Jonathan. We're moving on now to something slightly different. We're going to be looking at the commercial property aspect. James Hodgson is a partner and commercial property lawyer. He's going to be looking at tenants' rights and the importance of getting any property agreements reviewed. James?
Hello, everybody.
Thank you.
Thank you. Hello, everybody, and thank you for the introduction, Amy. As she said, I'm a commercial property partner based at our Bury office. I specialise in all areas of commercial property, including landlord and tenant acquisition, disposals, and your usual development work. I'd like to talk a bit about commercial leases and protection against forfeiture, and reviewing the various property agreements, including leases and conditional contracts. So obviously at the start of lockdown, government required all non-essential businesses to close their premises, and the general public was advised to stay at home. Some types of non-essential businesses, including many shops, have now been allowed to reopen. However, social distancing measures still apply, and there are a number of businesses, mainly within the hospitality sector, who are still required to remain closed. Despite the government assistance via the various loan schemes, tax deferments, business rates schemes and furlough schemes, many businesses are facing difficult times, and this then has an impact upon their property agreements and people's property interests. The Coronavirus Act, and to a degree the proposals which are being put forward by the government in the Corporate Insolvency and Governance Bill, do provide some relief for tenants. However, they do place some restrictions on landlords generally. So most commercial leases contain a landlord's contractual right to forfeit the lease or bring it to an end and re-enter the premises. This usually keys off non-payment of rent after a particular period of time. It may be 14 or 21 days from its due date, general breach of the lease, and insolvency of the tenant. The Coronavirus Act in March 2020, introduced a 3-month suspension on the landlord's right to forfeit for non-payment of rent for business tenancies. And this 3-month period started on the 26th of March, and it's uncertain as to whether that's possibly going to be extended, but I suspect so, given that we're getting pretty close to the June quarter date when many rents will fall due again. Now, the suspension only affects the right for forfeiture of tenants in relation to forfeiture of leases in connection with non-payment of rent. Landlord therefore will have other remedies, such as a claim for damages, but it can't force the tenant to move out of the business premises essentially for a 3-month period. Now, the rent that is due in this 3-month period still needs to be paid, and the right for forfeiture will be reinstated at the end of the 3-month period. And accordingly, tenants are going to need to budget for that and look at their cash flow and potentially come to agreements with their landlords as to how they're going to manage that process if they're not able to afford the rent at that time. Now, the proposals in the Corporate Insolvency and Governance Bill go further and apply a temporary moratorium or freeze on statutory demands and winding up petitions in relation to COVID-related debt. The suspension of the debt recovery rights is due to apply from the 27th of April 2020 through to the 30th of June 2020, and 1 month after the Act comes into force. At present, that bill is still going through the Commons as we speak and through the various stages of readings. Now, it's uncommon for many leases to contain a rent suspension or termination provision that would be triggered as a result of a pandemic type event or other unforeseen event, and generally these provisions are not implied in English law. So we'll have to look at the provisions of the lease if we want to have any flexibility in that regard. I think the key thing here is for landlords and tenants to be discussing things and trying to take a measured approach, and certainly documenting any agreement that they do come so there is certainty for all the parties. Some landlords and tenants are using this as an opportunity to re-gear their leases. And from a landlord's perspective, I think another just practical point is to make sure that you're talking to your mortgage lender if you have one, because any agreements which you make with your tenants may need to be approved by them to prevent you from breaching any covenants contained within your mortgage or loan agreement. Another quick topic I wanted to talk about was break notices and break clauses. Some tenants are lucky enough to have break options at present, or others may well have served break notices and have their leases due to terminate shortly. Now, most of these break clauses require the tenant to provide vacant possession and to deliver up occupation of the property back to the landlord at the end of the lease. Now, these conditions can be quite strictly interpreted, and they're still going to have to be complied with. So tenants will need to be careful to make sure that they can clear the property of furniture and people. I suspect the people side won't be too difficult at the moment, and make sure that they can comply with these conditions despite the restrictions which we have on social distancing and despite the delays that are being caused within general commercial arrangements. People need to get removal people in. That might take longer than normally expected. They may need to carry out work to the property in order to put it back into a decent state of condition and repair. And again, that might take longer than is anticipated at the moment, either through shortage of workforce or shortage of supplies in the construction industry. Another thing I wanted to have a quick talk about was rent review clauses. Now, most rent review clauses say that time is not of the essence, which means that the parties can choose to delay the rent review. Now, delayed rent reviews have a retrospective effect, but the rent is always valued at the relevant rent review date. Now, a rent review date which occurred before the outbreak of COVID-19 should not be affected by the current crisis. However, one which falls after the COVID restrictions were put in place will undoubtedly be affected. For upwards only rent reviews, which are quite common, this will lead to obviously a nil uplift, where the review is downwards, it could, and upwards, it could lead to quite a substantial reduction in rent. Tenants might want to consider seeking to trigger and progress rent review negotiations with their landlord at the earliest opportunity in certain circumstances, so that's always something to bear in mind. Another thing that is coming up, of course, is renewal of tenancies. At the moment, some commercial tenants have a right of security of tenure if this wasn't contracted out of at the beginning of the lease. One important thing to note here is how the rent will be assessed on that review. Under the statutory procedure which is set out in Landlord and Tenant Act 1954, the rent reviews do not need to be upward only. Therefore, for a tenant who wants to remain in a property, there's a potential benefit in seeking to exercise and push forward the renewal proceedings so that the assessment of rent is made during the COVID-19 restrictions. And for some landlords, they may want to look at trying to delay any renewal hearings or decisions as long as possible so that they can allow the rental market to recover. Lastly, I wanted to just touch on a few issues which are facing some of our clients who are developers or landowners who may have entered into conditional contracts for the purchase of land. Often these contracts are conditional on planning, which involves preparation of various reports which are required to complete the planning process, all of which can be impacted as a result of the lockdown measures. Now, planning departments generally are continuing to operate, but they are doing so at a slower rate due to staff shortages and the lockdown measures which have been implemented. In other instances, contracts can be conditional upon construction work being carried out. Now, a good contract would contain potentially force majeure provisions or frustration, or you could rely on the concept of frustration, which essentially allows you to delay performance or get out of a contract in circumstances where something unforeseen comes up. Now, generally speaking, force majeure provisions aren't included in contracts aren't implied into contracts. A well-drafted construction document should contain a provision, and it's just important to check to see whether a pandemic type situation will fall under the provisions of force majeure, so that you can then potentially rely upon that in the event that you're not able to comply with a timetable and there's a delay in the process. I think the main thing for all parties concerned is to look to speak with each other about the potential delay and try and agree a formal way of coming out of it, and to make sure that any such agreements are documented properly so that there isn't uncertainty between the parties. If anybody has any questions in connection with anything I've mentioned, then of course they can ask in the Q&A panel, or alternatively email me or one of my colleagues directly.
Thank you, James. There's a question popped up in the Q&A panel for you, which we'll come back to at the end of the session. So our last speaker is Alex Sandland. He's a commercial litigation partner at Butcher & Barlow. It's going to be looking at what happens if things don't quite go according to plan. So looking at debt, insolvency, the property issues, and things like insurance claims. So, Alex, if you're there.
Hello.
There we go.
Hi. Thanks, Amy. Typically, I'm last on the list, and I hope that participant number doesn't drop too much. I shall be 4 to 5 minutes maximum. I'm Alex. I'm a partner in the firm, head of litigation, and I specialise in property and commercial disputes. I act on both sides, so both hunter and hunted, and so I'm intending today to give you a balanced view from all angles. My intention is to give a very brief summary of how the COVID impact and the fallout has affected the litigation process and the position of parties that are subject to the disputes or contention. So essentially, the shape and sound of the current litigation landscape and your options and opportunities. As an overriding point, I would echo and resonate that which has been said so far. There seems to be a constant theme here, and that central thread is one of engagement. Be proactive. Often litigation is seen as trouble and to be avoided, and typically clients will engage only when they have a problem. The prospect of formal court proceedings and costs potentially are unwelcomed, and it is by its nature reactive. But it doesn't have to be that way. It can be relatively painless, and often early interaction and attention secures prompt results. The best advice I can give is to be proactive. Consult your advisors as soon as the problems are foreseen, and it's more likely then that any costs in terms of time or fees will become an investment rather than a straight expense. Litigation has massive scope. Every case is different. I just want to touch upon 4 areas: debt and liabilities, which could be for non-performance, non-payment, retentions, or negligence; insolvency; property disputes; and a brief word on insurance. As a headline point, the court attitude at the moment is everything. It's the driver. They are the arbiters and governors of what happens, and they are expecting us all to be reasonable and realistic. They're under-resourced, they're under pressure, and arguably they are sometimes frustrating. We've also got the impact of the Coronavirus Act, which has given us some guidance. Debts, liabilities, no matter how complicated or complex, a good litigator should be able to pick it apart, identify the issues, and give you focus. COVID has slowed down the courts and thus the availability of remedies. The key now is that you have time, whether you are a claimant or a defendant. Payments on account for your trading are a good idea, as is credit monitoring. Look at your traders, suppliers, customers, see where they're at. Your contracts will need to be reviewed, and a reminder for all that your credit rating does not necessarily suffer just because a claim is intimated. This is significant because adverse credit will affect your ability to trade and will certainly flag matters for the banks. Don't be driven by the fear that bad credit necessarily follows accusations. Insolvency is often considered draconian, and it can be. Facing insolvency is terrifying at times, but it can also be a friend, particularly in a corporate context. We're expecting to see a rise in administrations and CVAs, which were always the light touch, and they were intended to give businesses breathing space. The alternative, liquidation or winding up, is much more savage and essentially signals the end of a business. It will also terminate leases in most cases. Pre-COVID, we had the pending reforms and the advent of the Corporate Insolvency and Governance Bill. And there's lots to it, and it looks like it will be amended again in view of COVID. But the key theme in that bill is that provisions are being introduced to provide a moratorium for companies to give them breathing space. And essentially, the government is looking at promoting business continuity, protecting jobs and economic recovery, which rather tips the balance in favour of debtors rather than creditors. We're going to see a move away from winding up and more towards conciliation and continuity. And this requires vigilance when trading. Personal bankruptcy is less of an issue at the moment. It's been largely held up since COVID. My understanding is that HMRC, who are the single biggest protagonists, are not currently presenting petitions. You can present a petition, but the courts are slow anyway, and it's likely to have any real effect. And remember, insolvency is not intended as a debt recovery tool. It never is, and it never was. In practice, it has become that because it strikes fear and forces payments. But the framework is very carefully crafted to allow and facilitate insolvency only when a debt can be proven and indisputable. That therefore requires creditors to be careful and measured so as to avoid any adverse fees, and it also requires debtors or affords debtors the ability not to panic. Liquidation, insolvency, bankruptcy is never a foregone conclusion, particularly given the court's attitude and under-resourcing. Property issues have been addressed by my colleague James. From a residential perspective, for those with buy-to-let properties or second properties, it is almost impossible at the moment to secure the departure of tenants. Notice periods have been extended to 3 months. All possession proceedings have been suspended for 90 days. And the latest update is that this will endure until 23rd of August. So for those with non-paying tenants, you can take steps, but you cannot adopt the one-size-fits-all approach. Particular circumstances will vary, and you need to tailor your approach. Commercial property, the Coronavirus Act, I feel, has tipped the immediate balance in favour of tenants because of restrictions on repossession on rent grounds. A landlord will struggle to take immediate possession action regardless of any lease provisions until the 30th of June review date. In practice, forfeiture is a dangerous issue anyway, and I would always advise cautiously that you secure a court order before exercising any rights of forfeiture. So again, commercial, we're seeing a reflection of the residential position where the balance appears to be tipped in favour of the tenants. There are some options for landlords. I see this as perhaps lip service. You can bring an action in debt for rent, and you can also invoke insolvency. But the reality here is that the courts are slow, and if the tenant doesn't have the ability or capacity to pay, then no extent of action is going to force a position. A final point, insurance. I'm seeing in the last week or so a rise in inquiries for D&O insurance, which is directors and officers insurance, typically taken out as policies for directors to protect them from exposure in circumstances where there are allegations of misconduct or misfeasance. Check your policies if you have them, because we know that insurers and underwriters are looking to avoid. So if the heat follows, we need to ensure that we have an early grip on that. The other insurance point is one of business interruption. It's topical, it's hit the headlines, and it's a hot potato. We have instructions in relation to a group action by a number of leisure sector operators, and a case will follow subject to the current test case with the FCA. If you have a business interruption policy, I feel that you should be prepared to fight for it. I think the insurers have been very obvious in their intention to avoid, and I think it is unfair. And I think we're going to see some sympathy from the courts and the government in order to avoid a larger fallout, especially in the leisure sector, who can't yet reopen and trade. My conclusions, therefore, yes, there is uncertainty, which is central. It's government uncertainty, it's courts uncertainty. We can help you guide that. There are delays, and the balance appears to be tipping in favour of tenants and debtors. It's likely a political, economical and social intention. Creditors and landlords need to be proactive where possible, especially in relation to their leases, their contracts and their trading relationships. And early engagement is essential, both with clients and suppliers, and more importantly, with your advisors. Some comfort, a cuddle for the final paragraph. I would be more than happy to discuss any case or circumstances with anyone informally and without obligation. If anyone wants to chat about potential litigation, then I'm always welcome.
Oh, thanks, Alex. If all the panelists can just turn the video on and unmute themselves, please. Thank you. So thank you all to all the attendees for bearing with us. We obviously have run slightly over what we anticipated, but we have covered an awful lot in that time. I believe that we've answered all the questions in the Q&A by typing answers. If there's anything that you don't feel has been answered, you can contact any of the speakers at any time to deal with those specifically, or if you want to pop a question up in the next couple of minutes on that Q&A. You will receive, after we've closed down the webinar, a feedback form. That feedback form will give you an option to say whether you would want a more detailed webinar on any of the subjects that we've covered today. As I think as everyone said, we've had to quickly go through quite a lot of the information, and it is they're all really big topics that could really probably take their own webinar up. So if you do want, or you do think that there's an appetite for another webinar on any of the topics that we talked about, please fill in that feedback form and we'll take that on board. And there's no questions popping up, so I think, yeah, I'll just say thank you all for joining. Thank you for the panelists for your insightful presentations, and get in touch if you need us. Thank you very much.
Thank you.
Thank
you.